Hello, IBC companies. This is a quick screencast to help you as you prepare financial statements for your IBC companies that you'll be presenting to loan committees and to the board. First of all, publicly traded companies are required to file 4 financial statements each quarter with the Securities and Exchange Commission. Those 4 financial statements are the income statement, the balance sheet, the cash flow statement, and the statement of shareholders' equity. However, in your IBC companies, you'll only be required each week to present 2 financial statements, the income statement and the balance sheet. And this will be critical also to compile as you're getting ready to forecast your business operations. You need to have an income statement and balance sheet at a minimum. You can try and develop a cash flow statement, but this won't be required until probably the end of this semester. Now I just want to review with you the layout of the different financial statements. The income statement layout basically is revenue minus expenses gives you net income. Starts out with revenue, and then you subtract your costs of goods sold to give you a gross profit number. Sometimes this is called the contribution margin number, or sometimes they even call it the gross margin amount, but most companies will call it gross profit. And then you can do a percentage of that to see what your gross margin percentage is, or your gross profit percentage. But then you take away your operating expenses and it leaves you with operating profit, and then you take away interest and tax expenses and you get net income. Now all of your companies will have an interest expense because you start out with a loan from the loan committee and you have to accrue interest on that. I think it's 1% a week, and so you will be recording interest expense each week. You do not have an income tax rate, but some of you may have sales tax. That would actually be part of your operating expenses that you may be recording and reporting. Now the balance sheet layout is basically along the same lines as the accounting equation. It starts out with assets equals liabilities plus owner's equity. So your balance sheet must always balance. Assets equals your liabilities and your equity. It's important to know that. And then your cash flow statement basically starts out with net income plus or minus cash adjustments gives you net change in cash. There are actually 3 different sections to the cash flow statement. There's the operating activities, the investing activities, and the financing activities, which hopefully you can go into your old accounting books and get more detail on that. But basically, all IBC companies need to recognize that every transaction that you do has 2 parts, a debit and a credit, and those debits and credits must always balance. Assets increase with debits and liabilities and equity increase with credits. Net income, which flows into retained earnings, it increases retained earnings, so net income is actually a credit. So revenue is increased by credits and expenses are increased by debits. Kind of your basic accounting 201. And just so you have kind of an overview or a pictorial view of how the financial statements work together, the 2 basic financial statements are the balance sheet and the income statement. Those are the foundational financial statements. Everything else is built on those 2 financial statements. And the income statement and the balance sheet actually work together. You have the balance sheet over here, but net income, after you calculate net income, it actually posts into the retained earnings section of the equity part. And so they do work together, and the balance sheet must always stay in balance, and every entry has 2 parts. And I'm going to walk you through an example of some entries you need to be aware of as you run your companies. But in order to record this information, there's kind of 3 steps in the recording process. It's important to have some type of general ledger where you can record all of your transactions. Everything that occurs you need to record. In most companies record it in a general ledger, and then they compile or summarize all the general ledger entries into T accounts or summary accounts, and then they consolidate the summary accounts into financial statements. And I'll walk you through that process here at the end of this screencast. Now on top of that, there may be some additional schedules that you use to track certain items, such as sales. Even though sales is going to be recorded in the sales or the revenue account, most financial analysts want more detail about their sales. Exactly what product are you selling? So you can do a little bit more analysis on what products are selling the most, what products sell on certain days as opposed to other days. It gives you more detail and more information that you can use in making decisions. Same thing with inventory. Inventory, it's critical that you track or have a way to track your different batches of inventory. If you're running a food company, you may have bread and meat and lettuce and tomatoes and onions, all these different inventory bins that you need to track so that if you're getting close to running out of something, you can go purchase it or buy it before you run out. Another schedule may be needed for marketing expenses. Sometimes you'll have some marketing initiatives that'll run over a couple weeks, and you want to see what the rate of return is or something. Just something you can track, a schedule that you can track these different areas that may not necessarily be reported in the financial statements, but it helps you have the data that you need in order to make correct financial decisions. Now, there's some basic guidelines that you need to follow as you're creating the financial statements for your IBC companies. First of all, this is critical. The balance sheet must always balance. Assets must equal liabilities plus owner's equity. Now, your beginning balance sheet is going to start out with basically cash that you get from the loan committee, and then the notes payable that you owe to the loan committee. That is your beginning balance sheet. And then thereafter, the balance sheet will change as you buy inventory, as you sell goods. The balance sheet will change. Now, items that are purchased to sell to customers, they need to go in as inventory. It doesn't go in as cost of goods sold. It sits over on the balance sheet as inventory until it is sold to the customer. And then it's reported on the income statement under cost of goods sold. Equipment that you purchase for your IBC companies should be capitalized and then depreciated over the remaining weeks of the IBC that is going. So, for example, if you spend $200 to build a sales kiosk or something, you're going to use that kiosk over 9 weeks. You wouldn't want to expense the whole kiosk in week 1, but you'd want to spread the expense of that kiosk over 9 weeks. If you buy, say, a deep fryer for whatever reason, like if you buy the deep fryer for, say, $180, and you're going to use it over 9 weeks, that means you would depreciate it $20 a week until at the end of the 9 weeks it has 0 value, if that's what you want to state. Or you could say that maybe there's some salvage value. You think you'll be able to sell it at the end of 9 weeks. But in any event, equipment should be capitalized and depreciated over the remaining weeks of the IBC companies. Now here's some glossary of terms. This PowerPoint's also posted out there on iLearn, so you can go through this PowerPoint and look at the different terms. I'm not going to read through them with you right here. IBC companies, you guys are mainly kind of run as a cash basis companies. You don't really have any outstanding accounts receivable. You don't ever sell things on credit. Some of the food companies may have an accounts payable with Cisco because you buy stuff and you don't have to pay for it right away. Or sales tax payable or accrued interest expense. Maybe some of the different accruals that you have. But for the most part, you're on a cash basis except for some of those accrual entries that I just mentioned. Now, let me show you kind of an example of how you could, let me move this over a little bit. Hopefully you can see that. How you could record a sample entry. So here's a general journal. And maybe my very first entry is going to be, let me change this. The loan committee. Wow, I can tell I need to. Sorry about that. These weren't quite formatted correctly. Okay, so the loan committee. Suppose you go to the loan committee and you get cash. And you're going to go to the loan committee and ask for $1,000 cash. So you start out with a $1,000 debit and a $1,000 credit. Cash is increased by debits and liabilities are increased by credits. Then I come over to my general T accounts and I'm going to say, well, for entry number 1, I know that I had cash of $1,000. And I also have a note payable of $1,000. Okay. Now with that cash, I go out and buy some, I don't know, maybe I go out and buy some hot dogs. I'm going to sell hot dogs. So I'm going to buy some hot dog buns. Now I know that I'm spending my cash, so my cash is going to go down. So that's going to be a credit. Say the hot dog buns cost me $10. It's got $10 there and $10 there. Now my hot dog buns are actually inventory. So for entry number 2, I know I have a debit of inventory of $10, and my cash goes down by $10. Okay, there should be a sum down at the bottom. Okay, now suppose that was the only thing that happened during the week. Then when I go to create my financial statements, I'm going to come over here and say, okay, cash, under my summary accounts, I have a remaining balance of $990. So I have cash of $990. I have inventory. I'm going to come back over here and show you where my inventory was of $10. So my total current assets is $1,000. Total assets is $1,000. And my note payable is $1,000. Now these are just some templates that I created. You can create your own. Any of it. So my balance sheet starts out by balancing. Got $1,000 of assets and $1,000 of liabilities and stockholders' equity. Now, as you go to make sales, maybe you can just record in the general journal daily sales, but you need to have a separate sales detailed list that will show you the breakdown of all your sales. So that's basically how you're going to create your financial statements. I would encourage you to have a general journal, then some type of summary T accounts, and then your financial statements. Good luck.